Let me ask you a question. What does $100 a week look like to you? Grocery trips, pizza night, fancy coffee on the way to work. It feels like money that just slips through your fingers, doesn't it? Most people underestimate how powerful small, consistent amounts can become. They see it as spending, not as a life-changing tool. What if I told you putting aside just $100 every week could be the single most important financial decision you ever make? Not a get-rich-quick scheme, a get-rich-for-sure plan. We've been told wealth needs a huge income or luck. That's a lie. The truth, anyone can build a massive nest egg with discipline and time. Teacher, truck driver, nurse. The math is the same for everyone. That $100 isn't just money, it's a seed. Plant it right, and given time, it becomes an oak tree of wealth. 100 a week is roughly 14 a day, a manageable step. Alright, let's talk about the secret sauce. The eighth wonder of the world. It's a concept called compound interest. It's actually very simple. When you invest, you hope to earn a return. Interest. With compounding, you don't just earn on your original money. You earn interest on the interest you've already made. Your money starts working for you, then the money it earns also works for you. Your interest starts making its own interest. Imagine $1,000 earns 10% in a year. That's $100. Now you have $1,100. Next year, 10% on $1,100 is $110. Now $1,210. It builds on itself, slow at first, then it accelerates into an unstoppable force. Broke people work for their money, wealthy people have their money work for them. Every dollar saved is like an employee working 24/7. Those new dollars get hired too. Your financial army grows. Investing $100 every week keeps sending in fresh recruits. Not hot picks, disciplined deposits into good growth stock mutual funds over many years. I love the snowball metaphor for compound interest. Your first $100 investment is tiny. You give it a push. At first, it's not impressive. The first year or two of investing can feel underwhelming. You wonder, is this really working? Most people get discouraged and quit. Why done dormon in trans? Why doaba? Chai bodastil dorio added jodo adding another $100 every single week. Each pass, more sticks. Growth compounds, then growth stops being slow, it accelerates. Soon, momentum does the work. After 10 years, 20 years, 30 years, the snowball becomes a boulder. The final year's gain can exceed your entire balance after year 10. Time, the length of the hill, matters more than the initial size. Start now, with whatever you have. Get the $100 snowball rolling, and let it grow. Alright, let's get into the real numbers. Let's say you start today. You commit to investing $100 every single week, no matter what. After 10 years, you'll have personally contributed $52,000. That's a significant amount you disciplined yourself to save. We'll look at 3 scenarios to be fair. Very conservative. High-yield savings, or a CD, about 2% annual. After 10 years, you'd earn about $5,800 in interest. Total around $57,800, more than you put in but barely keeping up with inflation. Moderate, 6% turns $52,000 into roughly $71,700, nearly $20,000 in interest. The snowball is noticeable now. Optimistic, 8% grows it to approximately $80,000, $28,000 in profit. Over a third of your balance is growth you didn't save. This is the foundation. You've built a base. The real growth is about to begin. The hill gets steeper. Momentum takes over. Keep your eye on the line. The curve will bend upward. 10 years in, you've laid the groundwork. Now we let compounding flex its muscles. So, you stuck with the plan. You didn't get scared in downturns or greedy in upswings. You just kept investing $100, week in and week out, for 20 years. You put in $104,000. At 2%, your balance is about $128,000. $24,000 in interest. It took 20 years to make what the 8% scenario made in under 10. Playing it too safe becomes risky. You may not have enough for retirement. At 6%, your total is around $198,000. You've earned $94,000 in interest, nearly matching your savings. At 8%, your $104,000 turns into about $255,000. You contributed $104,000 and earned $151,000 in profit. Growth surpasses contributions. The snowball is now bigger than all the snow you added. Your money is doing more work than you are, and you still have 10 years to go. This is where compounding gets exciting. The curve steepens from here. 30 years of discipline, 30 years of consistency, 30 years of letting compound interest work its magic. Your total out of pocket is $156,000. The results are life-changing. First, the 2% path. After 30 years, that's about $214,000. Only $58,000 in interest. That's not a retirement plan, that's a disappointment. Barely outpacing inflation. Your money has been relaxing, not working. At 6%, your $156,000 balloons to approximately $423,000. You earn $267,000 in growth. Interest towers over contributions. The third decade alone outgrew the first two combined. 8%, your $156,000 transforms into roughly $612,000. That's over $450,000 your money made for you. $100 a week didn't just make you wealthy, it made you a financial success story. This is the mind-blowing power of a rolling snowball over time. I want to pause here, make something crystal clear. People get this wrong all the time. Saving money is not the same as investing money. 2% is what happens when you save in a bank, money market, or CD. Your money is safe, but it's not growing. Seeds in a jar won't spoil, but they will never feed you. Saving is for short-term goals, down payment, car, emergency fund. Short-term money must be safe and accessible, not exposed to market swings. But for long-term goals like retirement, parking money in savings is a major mistake. You guarantee losing purchasing power to inflation. Investing is for long-term growth, calculated risk for higher return. With good growth stock mutual funds, you own pieces of great companies across America and the world. As economies and profits grow, your investment value grows with them. 8% turned $156K into about $612K, 2% into about $214K. The nearly $400K gap is the price of fear. Match the tool to the goal. Save for short-term, invest for long-term. Put long-term money to work so compounding can do its job. You might think, but the market goes up and down. When should I invest? What if I buy before a crash? The myth is you must time the market perfectly. Nonsense. Winning isn't timing the market, it's time in the market. Invest $100 every week with dollar cost averaging. You automatically buy fewer shares when prices are high, more when they're low. It averages out your purchase price over time. Set it and forget it. Remove emotion and guesswork. Your shovel puts money in. The crockpot lets it cook for a long time. The disciplined, boring investor beats the market timing hero every single time. Don't try to outsmart Wall Street. Follow the plan. Automate $100 weekly. Every payday. Make it as automatic as your mortgage or electric bill. It's not about being perfect. It's about being persistent. Your future self will thank you. We've seen the math, the power of compounding, and the value of consistency. $100 a week can change your family tree. It's not about your income, it's about your outcome, the choices you make today. Most people just need to start. Push any button that gets you moving, find a pro, open a Roth IRA or a solid mutual fund account, or use a reputable brokerage app. Step 1, build a written budget and find that $100. Step 2, set an automatic weekly transfer into a growth fund. Step 3, be patient for decades. Don't check it daily or panic on corrections. Trust the plan, trust the math. 100 per week for 30 years can top $500,000, even $600,000. Will $100 disappear minor pleasure? Or dar decher barnagriga discarn arde. Gustadar bomber. Plant the seed, take the first step today. Your financial future is a weekly habit.